Good afternoon and welcome. I am Nande Boss, your host today, as we unpack the GraySwan cautious fund of funds performance and portfolio construction and explain to you how such a solution can be considered when looking at your more conservatively structured portfolios as part of a component of your overall or total investment strategy. It is so good for me to see all of the beautiful faces here today. GraySwan is one of the most experienced independent advisory investment management businesses. We service both institutional clients like retirement funds and private wealth clients. As our focus is an objective investment advice, we have developed various investment models or solutions for our clients, where our clients can choose and customize their offerings. We've also have 3 registered unit trusts. Our fund of fund unit trust has over 3-year track records, of which the GraySwan SCI cautious fund of funds we'll be discussing today has outperformed its benchmarks and peer groups over the short, medium, and long term. A few minutes before I signed in, I was actually thinking, I went into my own zone. I was thinking about the relationship between health and growth. I was thinking about when we focus on health, when we focus on doing the right things, when we focus on doing the right things for the right reasons, over time, that area of our lives will grow. Healthy things do grow. This is also true of the GraySwan story. We have focused on building a healthy business, on building relationships, on doing what is right, on doing what we know to do well, and looking after our clients, looking after the health of our clients' portfolios. And this has resulted in the business growing from strength to strength. In the last year, our retail book grew with 16%, albeit in very tough economic conditions. To set our clients up for further growth, we have launched various offshore currency megatrend thematic equity portfolios, namely a global disruption equity portfolio, which has a 6-month track record already and returns more than 20% in US dollars. We've also launched a healthcare innovation portfolio that has launched just over a month ago. We are working on blockchain portfolio as one. We're also working on a commodity portfolio, which will be investable in the next month. It is a very good health indicator when we see that as GraySwan, we're not just watching the world unfold or the world change, but we're leading in the change. We're part of the change, and we are growing with this changing world. It is exciting times for us as a business, and I believe it is exciting times for our clients and future clients. Mega trends are here, and we are certainly not watching from a distance. We are in it and we are leading it. So without further ado, I'd love to introduce the speakers for today. Gregor and Duncan, 2 of the founders of GraySwan, which is more than 10 years old now, together have over 40 years investment experience, of which 10 of those years are in offshore alternative investment management. They've consulted to the largest and most prestigious funds in South Africa. Duncan and Greg are an integral to the investment management process, which makes them the 2 key individuals that are present at this event today. We are honored and incredibly excited to hear from you 2 gentlemen. So over to you, Greg.
Thank you, Nandi. Let me just quickly share my screen here. There we go. Are you able to see that?
Yes, I am. Thank you.
Thank you. Well, afternoon, everyone. Thank you for joining us today. So I just want to take you through what's happening in the markets globally, what's happening with COVID cases, and what's happening with economic activities, and then take you through some of the ideas and portfolio positionings we currently have within the portfolios. And then thereafter, Duncan will take you through the positioning within the fund itself and also performance within that fund. So let's just start off with COVID-19. So what you can see here is really the number of COVID-19 cases per million people, and that's per day. And what you can see is that South Africa, which is in green, has gone through 2 waves, and we're speaking about a 3rd wave potentially here at the moment again. Interesting is that you could see that the first, or let's rather say the 2nd wave, came during the winter months of last year. And I think that's potentially the worry we have locally at the moment, is that if you look at Europe and if you look at US, you know, during the winter months, you do see these spikes in COVID-19 cases. The good news is that COVID-19 cases across the globe have come down dramatically. It's not just that COVID-19 cases have come down dramatically, it's also about the number of deaths. The death rates are key. And here you can see, just based, you know, when the original lockdowns occurred, what the death rates were, and it was high. And I think one of the issues was during that period not knowing how to handle COVID-19 as an epidemic. I think as the world has got better in it, but you can see why we had the big lockdowns within South Africa last year. And this is where we had sort of these spikes in death rates. But again, the good news is that death rates have come down globally quite dramatically. And it's a function of 2 things. It's a function of very hard lockdowns, specifically within the Euro region, and then also the election of President Biden last year, who implemented various policies to try and curb the COVID-19 infection rates. And you can see these rates coming down dramatically. Looking forward, the key to economic growth is going to be how quickly each of the country can actually open up. And that's going to be dependent on vaccines and how quickly country can roll out vaccines. So before I go into the next slide, we're going to do a quick poll in terms of vaccinations globally. So we'll set up a quick poll, and if you can just answer that poll for interest's sake, that'll be quite interesting. So you can see here on the poll, it says which country has administered the most COVID-19 vaccine doses per 100 people? Is it South Africa? Is it the United States? Is it the United Kingdom? Or is it Israel? There we go. And so from the voting, 82% of people voted Israel. So what it tells me is we have a very informed audience today, and that is the case. So if we go into the amount of vaccines administered per 100 people, you can see Israel is leading the globe, followed by the United Arab Emirates. Then you can see Chile, United Kingdom, United States. Unfortunately, South Africa is still at the bottom there. And it's going to be key for South Africa to roll out vaccines, because the quicker we can roll out vaccines, the quicker we can open up economies. Let's just focus on Israel for a second, because that will give us a trend of what we think will happen in future. So if we look at Israel, and on the left-hand side, you can see the number of doses administered per 100 people. And what you can really see here is that the orange line keeps increasing, and as more people are vaccinated, you can see the dark bar as well as the line coming down dramatically. And those dark lines and bars are really the amount of new patients per day, or severe patients per day. And the trend is clear. The trend is clear that as vaccines rolls out, we see less sick people. So that's very positive from Israel's perspective. And on the right-hand side, you can see the number of new cases over 7-day moving average versus the number of deaths. And again, you can see the dramatic drops. So what's going to be key is to get people vaccinated, to get their mindset right to get vaccinated, because there's a lot of hesitancy. We see this in the United States as well, specifically people that voted for Donald Trump, where they don't want to be vaccinated. But the data we're seeing tells us that vaccinations does work, and it does severely bring down the number of sick people. So this is all positive. So as vaccines roll out, we should start seeing economic activity. On the left-hand side, you can see the number of days to herd immunity based on vaccine rollouts. And you can see that the US and the UK should reach herd immunity towards August of 2021, August of this year. Canada towards May 2022, and the European Union only towards September 2022. So they slow, and you can see that in the stats I showed in terms of France and so forth. They're really still struggling with COVID, people getting sick from COVID. On the right-hand side, what we can see is that that's the number of flights within the European Union as well as the US. And what's the point behind that? The point is that the quicker countries can roll out the vaccines, the quicker people will start traveling, the quicker we will see mobility, and the quicker we will see economy starting to recover. And we can already see in our people starting to fly and to move around again. But from a global perspective and the COVID-19 perspective, there's a lot of positives, and that's priced in the markets. So if you had asked yourself from the bottom of the market, which was the 24th of March of last year, and ironically today is the 25th, so it is 1 year in, which asset classes would have done the best? And if you look at in base currency, meaning in rand terms, for South African assets and for the US market, which is the S&P 500 in dollar terms, how much have markets recovered and rallied? And believe it or not, the S&P, which is the US stock market, is up 76.89%. The JSE is up 75.84%. It's rallied almost as much as the US equity markets. So it shows you that you need to sit in equity markets for a period. We've had a lot of investors during the period of February and March last year that were concerned about it, and we told them just sit through the markets. You have to sit through this. And if you had stayed in the market during this period, your equity exposure would have gained roughly 75.84%. So the good news is that markets have recovered from the COVID-19 pandemic of last year, and markets have rallied and actually reached new highs. So that's fantastic. In terms of looking at assets in rand and dollars, so this graph shows you the S&P, the US stock market in rand terms. So the previous slide showed you that in dollar terms, the US stock market was up more than the JSE, but in rand terms, the S&P 500 was up only 46.49%, so roughly 30% below the JSE. Why do I show this slide? Because currencies makes a massive difference. And what we do in the cautious fund is to hedge currencies out to make sure we don't lose the gains on the currencies when the rand strengthens. And Duncan will speak about this. So it just shows you the impact of currencies over certain periods of time, and specifically in this last period. From an equity market perspective, as I mentioned, markets are forward-looking. So markets have looked through the COVID-19 pandemic we've had, and markets have recovered. Markets have said, well, the world will recover from this, and markets have rallied. We've had one of the biggest equity market rallies we have seen in 100 years. And where we are today, if you look at the S&P 500, which is the US stock market, and if you look at the price to earnings ratio, which just shows you the valuation thereof, if the PE valuation is low, it means equity markets are cheap. And this is the US market. If PE valuations are high, it means equity markets are expensive. And equity market, specifically the US equity market, seems very expensive to us at this point in time. So we think there's an opportunity to move into different markets and into different sectors of the market. We've seen this through various sectors that what has done historically over the last 10 years doesn't necessarily do well over the next 10 years. And you need to buy into cheaper markets. This slide just shows you in gray the US stock market, how well it's rallied over the last 11 years, basically outperforming the rest of equity markets, excluding the US, by dramatic margins. And we think there's opportunities to move into Europe, to move into emerging markets and other sectors of the markets which are cheaper. And as these economies start to recover, you should see an uptick in these stock markets as well. You may have read a lot about value and growth. So there's two different styles in the market. You could invest into, and growth stocks are really these big tech stocks, the Facebooks of the world, the Alphabets and so forth. And it's these stocks that's rallied very hard. But these stocks rally through cycles, and it's dependent on what happens on the 10-year US Treasury yield, meaning the yield that the US 10-year bond pays out. And you can see in the slide, as the yields have come down, real yields relative to inflation, growth stocks have rallied very well. But as yield starts going up, and this is our anticipation, that we think yields globally will start going up, but therefore we think that you should start rotating into more cheaper stocks such as the value sectors. This is just a slide on the left-hand side that shows you the price to book ratio of emerging markets relative to the US stock market. And when the ratio is low, it just means that emerging markets are very cheap relative to the US equity markets. And you can see it run through cycles. And the point behind it is that if you buy into certain sectors of the market at cheap valuations, you have a very high probability of doing very well in the future. And the point being here, that if you had bought into the emerging markets, such as South Africa, such as China, such as Brazil, during the previous period where emerging markets were as cheap as it is today relative to the US equity markets, during that 8-year period, emerging markets rallied 258% and the JSE rallied 304%. The US stock market during that period only did 9%. It basically gave you no return because valuations were very expensive at that point in time. And that's key. So it's key within the portfolios to move between cheaper assets as we run through different cycles. Just from a sector perspective, within the equity components we look at, we think there's a big opportunity in basic materials, in our mining companies, for instance. Those stocks are really growth and value stocks, meaning they are relatively cheap and they are actually growing. And one of the positive signs we could have looking forward is that we're going to go globally into this drive of investment spending by countries. And I mean, if you look at the European Union, they're going to be spending close to 1.9 trillion on investment spending to reduce carbon emissions, meaning to build new infrastructure in renewable energy, in electric vehicles, these types of things. So we think there will be a big demand going forward for commodities as the world moves away from this high carbon emission environment to a much lower carbon emission environment, which will be a structural shift in how the world has operated for the last 30 years. And therefore, there could be a big demand for commodities, as we run into the next couple of years with big infrastructure spending. And the point behind it on the left-hand side is that basically commodities over 10 years haven't rallied very hard. You're coming off a very low base. And therefore, again, as demand starts picking up, that should increase prices and that should increase the profitability of various of the mining companies as well. Just from an investment perspective on fixed interest, if you look at the South African nominal bonds, so South African government bonds, the 10-year and the 30-year government bonds, there's still a lot of opportunities here. Currently, you can get 9.5% to 10% on South African government bond yields. Inflation came out at 2.9% in the week. Therefore, you can get almost inflation plus 7% on the yields within the government bonds. So we think there's a lot of opportunities. For South African pensioners and for conservative investors, these yields are very high. If you are a European investor, and you had to buy German bunds, meaning German bonds, you would basically be paying the German government to buy into their bonds. So they're not in a great opportunity set in terms of bond yields, where South African investors are. So there's an opportunity. In the inflation-linked bonds, which the South African government also issues, and some corporates, you can see that the inflation-linked bonds are paying roughly 4 to 4.5% above inflation. So if inflation's at 4.5%, then the bond would pay out 4.5% above inflation, so you can get 9%. So again, a very lucrative investment opportunity at this point in time. And again, within the conservative portfolio, these are the type of opportunities we're trying to take hold of. Also, for clients withdrawing money out of your portfolios, if you get the stable income yield, it makes your drawdown or the volatility thereof much lower. So a lot of opportunities, we think, in the South African bond market. A lot of investors are worried about South African defaulting on debt, but what we can see is a lot of it is priced in the bond market. And what do we mean by that? It just means that The red line shows you the US high yield bond index. So basically what it is, that it's US companies issuing bonds which are not investment grade, and the yield they pay versus the 10-year US bond yield. And you can see these yields have come down to 5-year lows, whereas the South African bond yield relative to the US Treasury yield is not close to the levels we've seen historically. And therefore, we can see there's a lot of risk already priced in the bond yields, and that's why these bond yields are trading so high. So therefore, you know, even some South African risks, we understand that, but the yields are high, and it's worth getting these yields. From a Rand perspective, you know, we have a lot of South African clients that do want to diversify their money abroad. So currency is key, and taking money abroad at the right time is key. So last year, when the Rand was trading at 19.20, you know, we told our clients, just hold off, don't take money abroad now. And we didn't take money abroad within our conservative portfolios. We actually put some hedging structures in place, and Duncan will speak about that. Where the Rand is trading today, and if you can look at the blue line versus the black line shows you the real effective exchange rate. And that's really the fair value which we think the Rand should be. So it's roughly 14 Rand 50 to the dollar. The Rand's was trading at 14 Rand 50, today about 14.90, around about there. At these levels, we do think it's a good opportunity to start taking money abroad. Within the conservative portfolio, we increased our offshore exposure from roughly 11% up to in excess of 21% as the currency has actually strengthened at this point in time. And it's to give us protection, you know, if we have another risk-off event. So from a currency perspective, I think a good time to take money abroad. We are a bit worried about the currency at the moment because, again, if you look at the US high yield index, which I spoke about in 2 slides ago, versus the 10-year Treasury yield, US Treasury yield, you can see these levels are back at the lowest levels in 5 years. The Rand, which is in the dark gray line, has got a big correlation to the US high yield minus the 10-year Treasury yield. So if we start seeing these spreads move out again, you could start seeing the Rand depreciating again. So there's some risks, but again, from a currency perspective, we could see the dollar stay weak for a long period, as there's a lot of liquidity in the market, and it should stay there for a while. I think as soon as the liquidity starts coming out of the market again, you could start seeing some weakening of the currency. To call it at exact point is very hard, but we think at this point in time, a good time to actually start diversifying your assets and taking some money abroad. And that's it from my side. Thank you very much for listening to me. I'll hand over to Duncan. Nandi, I don't know whether you've received any questions.
Yes, there is one. And thank you so much for reminding our attendees that there is a Q&A bar. If you look at the lower level of your screen, there is a spot for you to put in your questions. Greg, there is a question that has come in for you, and it is, do you think cash will outperform inflation over the next 3 years, and why do you think so?
Thank you, Nandi. I think it's a great question, because what we've seen over the last 2-3 years prior to last year was a lot of investors having their money in cash, money market instruments or income funds. Why? Because the yields at that point in time was close to 9.5%. What's happened with the COVID crisis is that the Reserve Bank had to cut interest rates dramatically to try and stimulate the economy. So interest rates are low. So if you look at cash rates for institutional clients, you can maybe get 4% on a normal cash rate. For retail clients, less than that, you're going to get less than that within your bank normal call accounts. So that's the one thing. And then the second thing is that interest rates, we think, will stay low because South Africa typically has a lag of 6 to 12 months relative to the US in terms of interest rates. So we know the US Federal Reserve has already said that they're going to keep interest rates low until 2023. So they're not going to move interest rates. The Reserve Bank would probably not move it either. And they need to try and stimulate the economy. They're well aware of that. So we don't think interest rates will move up very quickly. And therefore, interest rates will stay low. But what we think will change is inflation. If you think where oil prices are today, roughly $64, $65 a barrel, you know, one of the biggest imports we have is oil. in terms of the inflation basket, and that could push up inflation. Secondly, we see the electricity hikes, which are going to come through again. That's going to push up inflation. So there's various inflationary and even global inflationary demand that we're seeing that would drive up inflation. So our view is inflation will start going up. And therefore, if inflation goes up to 4.5% or 5% even, and the Reserve Bank keeps interest rates where it is currently, you will underperform inflation sitting in cash. Therefore, you will get poorer and poorer. And therefore, within the conservative portfolio, it makes more sense to move money out of cash into a conservative portfolio where we can make use of, South African nominal bonds and inflation-linked bonds, which are paying you 9.5%, which is almost 4.5% higher than cash rates, with not that much risk. So therefore, the short answer or long answer is that, we think that cash will probably outperform inflation over the next 3 years. And therefore, investors need to look elsewhere in this environment.
Well, thank you so much. Ladies and gentlemen, that was Greg, our Chief Investment Officer. He and Duncan are co-managing the fund. We are now going to hand over to our CEO, Duncan Theron. Thank you.
Thank you, Nande, for that introduction, and good morning to, I see a lot of clients, potential clients, and even a few family members. GraySwan, with your clients, you are actually a family member, so welcome to our coverage of our GraySwan Cautious Fund of Fund Unit Trust. I have to compliment Greg, for him to cover the markets in 20 minutes in 15 slides is quite an accomplishment, because he has to select out of his pack of about 5,000 slides. He's really passionate about the markets, as you can see. So Greg, thanks for that introduction, and a great foundation for me to cover an update on our unit trust and the performance and the portfolio positioning. Let me just see if I can move the slide. There we go. So firstly, just for everybody's overview, the performance objectives of the GraySwan Unit Trust is multiple. Well, firstly, we have to outperform our peers. That's the major objective. So you can see on the fact sheet, which is on our website, which has been distributed, it's to outperform the multi-asset low equity category over 3-year rolling periods. That category currently consists of 167 other funds. So that's the reason why we started this fund. There are so many funds to select from, it becomes really hard for investors. And we believe we know who are the best of breed managers. We select specialist managers. For example, we select specialist equity managers, specialist cash managers, specialist offshore managers, and then we combine them in a portfolio. We handle the asset allocation and all the risk management, for example, the hedging. It's not just about outperforming the peers, which we have over the short, medium, and long term, but it's also for us yielding an inflation plus 2% return over 3-year rolling periods. So this fund has, since inception, yielded about 7% after all fees. 7% sounds low, but to Greg's point, inflation has been around 3%. So at least we've met that target. And furthermore, we have a risk management guideline that we do not want to lose capital over any 12-month rolling period, because the investors that consider this fund are people either close to the retirement or in retirement, or that require some form of an income stream. So they can't tolerate massive losses. What needs to be known about this fund is that it has no capital guarantee. It's not a cash type smooth return portfolio. It can lose money in the short term. And during COVID, it lost about 8%. From the peak, the high point, to the trough. As you know, equity markets dropped 35% in less than a month's time. So this portfolio is really about consistency over 12-month rolling and trying to meet that objective of inflation plus 2 and also outperforming the peer group on a 3-year rolling basis. The next slide is just some information. What is important about this fund, it is a Regulation 28 compliant fund, meaning that it's good for people that's saving for retirement. It therefore caps us that we cannot allocate more than, let's say, 75% to equities. In fact, the category in which this unit trust is listed is the low equity unit trust category, and there we cannot invest more than 40% of the fund in growth assets. So you can never really get a big surprise because we are constrained from an asset allocation perspective. You'll see later on that we are far more conservative than those restrictions, and we are also more conservative than our peer group. For us, this portfolio is about beating the peers, but with fewer surprises. Something also important about this fund is that, yeah, it's the little baby in GraySwan, only about 76 million. So it doesn't always bear the importance that it actually has. And I think we've decided to showcase this portfolio today because there are many investors that are just sitting in cash, concerned about the markets, not redeploying their cash. And the conservative unit trust is an ideal vehicle because it's well balanced, protecting on the downside and giving you upside. Also very important, if you look at the bottom of the slide, you can see that our total expense ratio, meaning if you include all the administration costs, investment management costs of the underlying managers, and the fee that we charge to manage the portfolio, the total cost is 1.29%, including VAT. If you invested just in an average fund out there, it would have cost you 1.747%. And that's just an average fund. We outperform the average. Our motto at GraySwan is always to provide a lower cost experience than the industry. And we've done that with all our unit trusts and to obviously outperform. On the previous slide, I showed you the two co-portfolio managers, Greg and myself, and I showed Greg right at the top. And there's a significance in that because about a year back, we decided to make Greg the Chief Investment Officer of the firm. Previously, I fulfilled that position, but we think that it was time to give Greg the reins. Albeit that I'm the co-portfolio manager, Greg is driving our local unit trust, and he's done an exceptional job, as you'll see later on. I'm showing this slide. I feel a little bit like a Warren Buffett. I'm an old school thinker, very much valuation based, long term. You can see I've also got a set of glasses. Whereas if you can see a guy like Jim Rogers, slightly younger, no glasses. For me, this is Greg. And he's saying that you cannot invest the way the world has been, but you've got to invest the way the world is. And that's what happened in COVID. The world has changed. We were disrupted. And I have no doubts that we will be disrupted again, literally in the next 12 months. There are more volatility and uncertainty to come, and we've got to think about investing differently. And that's exactly what we did in March, April of last year. We started changing the way we're managing portfolios. We do not have this long mindset anymore. We have to look at the portfolios on a shorter term basis because there's so much noise in the market and so many announcements by the Fed and governments and banks and Twitter feeds and a new president that we have to react faster. So our investments are not so much driven by a committee anymore as we used to, by 4 or 5 or 6 individuals doing research, meeting monthly, deciding on our views, but actually on a daily basis where we start at 7 in the mornings, we look at the market, we make decisions before 10 o'clock in the morning and we implement before lunchtime. And later on, I'll show you the result of that. It's been a phenomenal move. The performance since inception of the portfolio in July 2017, so just over 3.5 years, you can see the brown line. We have outperformed the peer group, which is line B. As I mentioned, there are 167 funds in that peer group. We've outperformed that. You can see historically, we outperformed the peer group handsomely. We were actually top quartile. COVID happened, and you can see, well, we weren't very happy about it. We lost a little bit more than the peer group. The reason for that is we weren't as exposed offshore because we felt that the Rand could still stay strong. And obviously, COVID took the Rand from around 14 Rand to the dollar all the way to 19 Rand 20. So that caught us on the back foot. What we then had to do is we had to fight back from our position in April. And you can just see how well we've performed. And this in a very, very strong bull market. But later on, I'll show you that we've actually done this at lower risk than our peer group. So we've not outperformed them in a strong equity market because we took on more risk or more equity exposure. It's actually the other way around. We've outperformed them by taking less equity exposure and making more smarter, smaller tactical moves and better risk management. For example, currency hedging. And I'll show you a little bit more later on. For us, what's important is that we are never going to be the top performer. Look at the last 12 months. If you had picked the best fund out of the 167, in perfect hindsight, you could have yielded a 42.64% return. If you picked the worst fund, you would have had a negative return when the stock market yielded about 75%. That is how big the range is between these funds. All that we want to do as GraySwan is we want to outperform the average of these 167 funds consistently over the short, medium, and long term by about 0.5% to as much as 1% and at lower fees. That's what we've done. Look at the last 3 months, 4.95 versus the average, 3.4. 6 months, 9.98 versus 7.30. Last year, above average. 3 years, above average since inception. Close on about a 1% average and at lower risk. Here's the risk scatter plot on the left-hand side. And this is really how we measure ourselves in this fund. What it shows is, you can see our fund has outperformed the average by about 1% since inception. We've also outperformed all the large brands. Now, we always say that investors, private clients typically just flock to whichever investment manager is putting an ad on the TV or is appearing in the latest Financial Mail, and the big brands just get more and more assets. But you can see we've handsomely outperformed the average and at lower risk. So that's what we're trying to be, because we are more nimble and we can move. And if you look on the right-hand side, you can see that we haven't done it at a lot of risk. Look at the local equity exposure, only about 20%. Look at our offshore equities, another 14%. We've been sitting with a lot of fixed interest exposure on the offshore side and locally to give us a buffer and just good income generation. What I do want to show you is just the last 6 and 9 months, because this is really where the change in our investment process have started taking part. And since Greg, as the new Chief Investment Officer, has taken over. So you can just see, look at the Cautious Fund, the handsome outperformance. I mean, that's about 11% over the last 9 months. And the peer group is sitting at about 8%, and we've done that at lower risk. Look at all the large brands. About 3% lower returns than ourselves and at more risk. So what we're looking for, what you can see is we're always going to be in the left quadrant, less risk than our peers, and we want to beat them at lower costs. And that's what you can see in the last 9 months and exactly the same in the last 6 months. So we are very, very happy with the results of this portfolio. It's been a lot of hard work. It's a daily process. It's not a monthly or a quarterly or a long-term process, although we look at long-term factors as well. How did we do it if we didn't take on more equity risk than others in this very strong market? And one of the major contributors has been our risk management. For us, the Rand dollar is the most volatile investment you can make. And the pendulum swings too far in one direction or the other. The Rand typically appreciates or depreciates too far. What we saw in COVID, the Rand hit 19 Rand 20. When we started seeing it appreciating at about 18 Rand 26, we started hedging our currency exposure. What that means is we started protecting our clients' money against the fact that the Rand can appreciate or strengthen further. Because if it strengthens, you actually lose money. And what has happened? Well, we all know that the Rand came down all the way to 14 Rand 50. The first hedge was put in place at 18 Rand 26. The second hedge was put in place at around 17.84 when we saw that, well, we believed that the Rand could appreciate much further. We were correct in perfect hindsight. You don't always get it right. Most of the times on currency hedging, we've added a lot of value. And that second hedge contributed materially to our outperformance. We then unwound these hedges at around the lowest level was 14 Rand 85. When the Rand was around 19 or 18.80 to the dollar, we hedged 60% of our clients' offshore assets. It was a bold move, but we believed it was the right risk management move. And it's contributed significantly to your performance in the last 6, 9, and 12 months. How else did we do it? There is value to be had if you can pick good and consistent, high quality, best of breed investment managers. But you also have to know where investment managers struggle to outperform markets, where you can actually just allocate to low cost passive tracker funds to bring down the cost of the portfolio. What the slide just shows you, these are the investment managers that we've allocated to. Some are well-known brands, others not so well-known. Maybe a new kid on the block is something like a Fairtree. We've been invested with them for the past 3.5 years. They have been the best equity manager for the past 3-4 years in the equity space. So glad we picked that one. Also like Catalyst is a pure offshore property manager. We started allocating to them. We've started allocating to some environmental, social, and governance mandates via Old Mutual. And these names and managers, we change dynamically. When managers do really well, we take profits. When a manager that we know has got a very strong team, a stable team, highly experienced, a stable investment process and philosophy, and where they've just suddenly underperformed, it's actually a time to allocate more money to them, because the best managers sometimes struggle, just like we struggled in March, April last year, but they typically come through. But you have to have the guts to allocate to those times of underperformance. So if you look on a see-through basis, you can see that the portfolio is really well diversified. The big allocations are really across these three names here: Coronation, Prescient, and Fairtree. These are income funds. So they are funds that are there to give us a 7 or 8% type return and to give us stability to the portfolio. What I've also shown here is some of the blue names. And the reason why I've colored them in blue is to show you that these are tracker funds, low-cost tracker funds. About 20% of the portfolio is low-cost trackers. It goes up to about 30%. We manage that dynamically. And if you want to read one of the best books you can read Winning the Loser's Game. And it tells you that the focus of a client or an investment manager should actually be on strategy and asset location and risk management, and not so much on the selection of investment managers and fund manager names. The reason for that is simply that the majority of fund managers struggle to outperform the market, and therefore we have a decent allocation to low-cost passive funds. So that's just on the performance. Going forward, that's always the key question. And Greg laid the foundation for this slide. If you're just sitting with your money in cash and you're concerned about the markets, well, if you ask the experts, and this was a study done by Glacier that came out this week, they asked 7 of the larger fund managers what is their view on the expected returns of asset classes. And 5 out of the 7 noted that they think money market and cash is going to give you lower than a 4% return. So you're barely going to outperform inflation, and after cost and tax, you're going to be below inflation. And look on the right-hand side, bonds. 4 out of the 7 think that bonds can give you an 8 to 9% return. We think so too. Listed property can give you upside. And look at the equity side. Our South African equity market at this point in time is actually currently undervalued, and one has to take an allocation to them. On the bond side, Greg has shown you a few slides. South Africa is one of the most attractive bond markets in the world. I mean, look at this slide. The 5.5% number that you see there is a real return. That means inflation plus 5.5. Currently, it's trading even at higher levels. Look at all other emerging markets. I mean, would you rather invest in South Africa and get a real return of 5.5, or would you invest in Russia and only get a real return of 2.2%? So our market has actually been clobbered or have suffered because of our downgrade and investment grade, and our market's one of the most liquid bond markets in the world. So foreigners have pulled their money, and our bond market, the pendulum also swung too far in one direction. It's too cheap at this point in time. Yes, we are worried about fiscal strain and budget deficits and everything, but at the end of the day, I think we are compensated for the risk. What's important about this conservative unit trust is that we continue to focus on yield, because we know that our investors in this portfolio need that income. And what I've shown you here on the left-hand side is that, yes, we're generating about 4.81% via our income fund. So this is like money in bonds and income assets, but we're also generating a dividend yield through equities. And if you add these two together, you can see that's about a, let's say, 5.8, 5.9% yield. And it's even higher than just income yielding assets. So yes, it provides the yield, but we believe it can also provide you with the upside, such as we've seen in the last 12 months. So if you have a view that you can put money away for a longer term than 12 months, this is the fund that you've got to consider. But of course, the income solution that you can also see on the slide is specifically constructed for our clients that need the income, but they can't tolerate any negative moves in the next 3 to 6 months. So it's a different portfolio. The cautious unit trust, you've got to be able to put your money away for the next 12 months to 3 years. The income model, very conservative. It's really there for the next 3 to 6 months. So who should invest in the cautious fund of fund? If I show you statistics over the last 20 years of about 1,600 unit trusts in South Africa, on this slide you can see that the GraySwan conservative unit trust falls into this category here. So it's a low to moderate risk profile category, but it's not as conservative as money market or income funds. And it's definitely not as aggressive as equity funds. But maybe that doesn't mean much to you. Let me try and explain further. This fund is really for investors that over the short term can tolerate some loss. If over the last 6 months, you picked the worst fund in the 160 funds in the category, you would have yielded a negative result of 5.92. If you picked the best, about 13.86, and just an average around 6 or 7%. So you have to be able to tolerate a loss over the next 6 months. If you can tolerate that, it's a fund that you can consider. For the medium term, if you're looking for that real return and quite a consistent real return, again, then this is the fund that you can consider. You can see, even if you picked the worst of the 167, it would have given you at least a positive return and close to inflation. If you picked one of the best ones, about a 19% per annum, and in the middle, about a 8-9% type of return. And for the longer term, if you can invest, let's say for a 5-year and longer period, you can see, well, even if you picked the worst fund, you would have yielded an inflation plus type return. And if you picked a good fund, you would have yielded 16.47% per annum. So what these slides are just showing is that the cautious unit trust fund can lose money over the next 6 months. Over the next 12 months, we'll protect value. There's no guarantee, but that's the way we manage it. And over the 3-year rolling to 5-year rolling, our aim is to outperform inflation plus 2%, which we've done. So we've basically met all these requirements of the fund. And that's why we're happy with it. We don't want to shoot the lights out, and we don't want to surprise on the downside. Now, we have been asked a lot of questions from investors that are looking for a higher yield than money market and income funds, but they cannot tolerate capital loss over the next 6 to 12 months. But they can't just yield a 5 or 6 or 7% return. The yield is too low. What do they do? Because finally, you can see here, inflation's picking up and interest rates will remain low. Well, the answer is in something called alternative credit. And we've just sent out a research piece this morning, which you would have received. We call them a snippet, with a very broad overview of alternative credit. There's some technical names about it, but alternative credit is simply non-listed, non-government, non-corporate debt. It's private debt. Go and read the article and ask your advisor about this asset class. This asset class fits in between that little blue circle, which is an income fund, and the current unit trust portfolio, which I've just shown you. It's for investors sitting in this bracket that can't tolerate equity risk, but the income generated from an income portfolio is still too low. And that's where we will be stuck for the next maybe couple of years, with rates being quite low. So we think alternative credit or private debt will be a very attractive asset class going forward. If you look globally, alternative credit is the fastest growing asset class in the world, because banks have stopped lending to corporates. Corporates need to go and borrow money from other sources, and that's where these type of funds come into play. What I do need to note to you is that alternative credit, it's a more sophisticated asset class. These are unlisted investments. They are less liquid, and we can only advise clients that are sophisticated and qualified to invest in this asset class. Right, Nande, as part of her introduction, told you a little bit about some of the things we're up to as a business. But before I give you an overview as part of my final summary, perhaps there are some questions just on the fund performance and the fund construction, which I can cover at this point in time.
Okay, let's check. Let's take some questions. Here is one, Duncan. Do you wish to launch any other unit trust funds which we can consider in the near future?
Thanks, Nando. Thanks for that question. There is one very specific unit trust that we have already started working on. It's called a worldwide flexible unit trust. It's a unit trust where we will be unconstrained in our investment views. The current 3 unit trusts are governed by Regulation 28 and also by the categories in which they are listed. As I explained, the Cautious Unit Trust is Regulation 28 bound, and also we cannot invest more than 40% in equities. We cannot even implement equity hedging. We cannot invest in exchange-traded notes and many other things, or hedge funds or qualified investor funds. The new unit trust that we will launch, hopefully in the next 4 to 6 months, will be a fund where we are unconstrained. We can apply all the entire tool set which we use for our large pension funds. I mean, for our large pension funds, these are size clients of 4 or 5 billion rand. We hedge equities, we hedge currency, we invest in alternative debt, we invest in private equity, and we can't do these things currently in our unit trust portfolio. So we like a golfer, and that instead of playing with 12 clubs or 13 clubs, we can only play with 3 or 4. So we're quite constrained. But within that constraint, I think we're doing well. The flexible feeder will really give us a chance to demonstrate our unconstrained best views. In that fund, we can invest 100% offshore, or we can be 100% locally, and we can actively manage that. So it's something that we really look forward to managing, which will talk to our true skill set.
Thank you. That's it from the Q&A side for now. Duncan, you can take us through the next part of your presentation.
Thank you for that question. Thank you, Nande. So just in conclusion, I do want to give everybody just an update on where we stand as a business. We are really doing some very interesting things that is very exciting for us. And the premise and focus is really about this concept that we've been disrupted. And we started doing the work on disruption actually about 2.5 years back, and then we got disrupted in February, March last year. I wish we had done this work 3 or 4 years back, then we would have been ideally placed. So we were a little bit slow out of the starting blocks, but at least we've launched some thinking 6 or 7 months ago, and it's done phenomenally well. All that this slide is showing you is that the world is disrupted, and a great research piece to look at is this research piece by Fury Research. And what they did is they went and looked at the largest companies on the American Stock Exchange and what their longevity has been over the last 100 years. If you look 20, 30 years back, the average big American company lasted or lived for 30 to 35 years. If you look at that today, these large companies their longevity is between 7 and 10 years. And then if they don't adapt and change, they die. And that's what we've seen. So we have to be much more nimble, and we've got to think about the future and how to invest for the future. And this is a great quote by one of my favorite investors, John Templeton. He just says that if you want to have better performance in the crowd, you must do things differently. And thinking differently is the motto at GraySwan. So we've started thinking differently 2.5 years back, and we started implementing some of the different thinking, which some of you have seen. For us, it's like, what is the next big thing for the next decade? If you look at the last 40 years, there was always something that produced outsized returns. It may have been gold at one point, or the NASDAQ, or tech stocks. In the last decade, it was these FANG stocks, Facebook, Amazon, Netflix, Google. The question is, what is it going to be for the next decade? Because most of our investors can put money away for the longer term. The answer for us is on the right-hand side of the screen, investment megatrends. And a megatrend relates to a powerful force that changes the world, that creates a new landscape for investors. I'll explain a little bit more. If you look 15 years back, which were the big stocks in the world? I mean, there's about more than 100,000 stocks in the world. If you looked at the 10 big ones, who were they? You can see on the left-hand side, Exxon, BP, HSBC. These are typically either oil companies or banks or healthcare companies. There's kind of one tech company there called Microsoft that we all know well. Look a little bit further on, and you can see right now who are the big companies. It's tech companies. Look at the new names on the block. Amazon, it's an online retailer. Alphabet, Facebook, Alibaba, Tencent, coming from Naspers, a very proud South African company listed on the Hong Kong Stock Exchange. Johnson & Johnson remaining in the top 10 together with Microsoft. So the world has changed in literally 10, 15 years. But the question is, what is the world going to look like 15 years from now? So that when we sit there and look back, we can say we didn't miss out. And we think mega trends will drive the performance of the best stocks going forward. And these mega trends are things like artificial intelligence, blockchain technology, cloud computing, robotics, and all these themes. Here's another slide that shows you exactly the same story from ARK Invest, which many of you have started hearing about. One of the fastest growing asset managers in the last 2-3 years, because they started thinking about mega trends. We've also invested in some of their funds. Their one fund that we invested in has done, I think, more than 200% in the last 12 months by just investing in disruptive technology. And you can see, what do they think? Blockchain technology. You know, we're all listening to people investing in Bitcoin, but you don't necessarily have to look at Bitcoin. It's a highly speculative investment. Nobody knows what the value of Bitcoin is and where it's going. It's an absolute guess. But you can invest behind the technology thereof in companies like NVIDIA and that creates the microchips or the computing power. And these are companies with cash flows, with profits, with management. You can value them. You can invest in these companies. We actually, like Nande said, we are building a blockchain technology portfolio, which we'll launch in the next month. But anyway, these are some of the mega trends that will scope and create the landscape for the next 10 years. What else do we have to look at? Well, you know, I look at myself and I think, you know, I'm an old school thinker, because if you look at all the millennials around us, they are now 1/3 of the world population. In the next 10 years, they will be 50% of the world population. They think differently. They're thinking about environmental, social, and governance. They want to invest in green technology, green energy. They want to invest in driverless cars, and the Teslas of the world. And these millennials are sitting with a cash pile in their bank accounts, and they're the guys pushing up the markets. And if you think that the US government has been giving checks out between $600 and $1,400 per week, I mean, that's 10 to 20,000 Rand a week that 15, 20 million US families are receiving. Most of them are still working, but they're pocketing it and they're chucking into the stock market. So we really have to start recognizing that the millennials is a growing force. And if you look at the middle part of the slide, the Gen X, like myself, and the baby boomers are becoming less important. The millennials are driving the way that the markets will behave, because they will be the majority of the investors, and we can't ignore that. And they will be investing in mega trends, like I've just explained. So we have produced various research over the last year. You would have seen, for example, the mega trends of the new normal mid last year. But then what we also started saying is that we've got to find low-cost investment opportunities, because the returns for the next decade will probably be lower than what we've experienced. So cost is going to be even more important going forward. And you can look at the research pieces. It's very detailed and it explains some of our thinking. This is a great slide. If you are asking the question, so how do I invest in mega trends and all these new things happening, but also cost effectively? Well, unfortunately, as an investment advisor, I can only tell you about 9 funds that are thinking about mega trends, and I've listed them there. Only 9. Our offshore database consists of about 100,000 funds. I'll show you more details just now. But unfortunately, these funds are not registered or approved by our local regulator. And most of those managers are not interested in registering it. But as an investment manager, GraySwan has what we call a Category 2 license. We are allowed to invest in these funds if we conduct the necessary quantitative, qualitative, and operational due diligence. Here's our database. If you just look at our 100,000 offshore funds, there are more than 134 funds that are focusing on mega trends and thematic investing, and they have more than 10 years track record. So these are funds that have really proven themselves, that have existing track records, strong teams, but they are unknown to South African investors. And furthermore, they're not interested in marketing their product here, and they can't actually because they're not regulated by our local regulator. But they're out there, and we can invest in them. But then GraySwan has to create a product under our fund management license. And that is what we started doing 6 or 7 months ago, because this is just an opportunity that our clients are going to keep on missing if we simply have to work on an advisory basis. We have to create product to incorporate these funds for them. Furthermore, if you ask the question, how many low-cost funds are there in the space? Well, on the right-hand side of the slide, there are more than 4,120 low-cost exchange-traded funds. I mean, these are funds that cost between, well, either sometimes free, typically from about 0.1% to as much as about 0.75%. So half to a third of the cost of an actively managed offshore fund, and 95% of offshore actively managed funds underperform the market. So invest passively, invest in low-cost ETFs, but invest in all these themes. And this is what GraySwan's all about for the next decade. And the other key point is that, as Greg has mentioned, we think it's a good time to start moving money offshore. And all that the slide is showing you is that historically, the rand is kind of at a fair value. But if you move your money offshore, where do you put it? You can put it in offshore cash and get virtually no return after cost. You can put it in offshore bonds. You're going to get a negative return because yields are moving up. Well, basically, you can invest in equities. You've got to take some risk, but which equities? And for us, there's so much noise in the market. Rather invest for the next decade and invest alongside mega trend and thematic thinking and low-cost vehicles. This is just an example of our disruption equity portfolio that we launched 6-7 months ago. It's yielded above 20% in dollar terms. And you can just see some of the themes it's investing. And it's only investing in ETFs, low-cost vehicles. The underlying investment management fee of those vehicles are about 0.3%. So very, very cheap. I mean, for example, autonomous vehicles. I mean, this is not just Tesla, which everybody knows. There are many other companies, Zoox or Waymo. There's a list of them, BMWs in this space that you can invest in. And so it goes on. We've also launched a healthcare fund. And for example, I mean, these are some of the themes in the fund. Targeted therapeutics. What in the world does that mean? It means these are companies that are trying to find the cure for cancer. And you can imagine if one of these companies finds it, I think the CEO of the major shareholders of that company may be the first dollar trillionaire and will be richer than a Jeff Bezos or a Steve Jobs and these guys. So these are the thinking across our megatrend portfolios. So just a last slide in closing. What you can really see is that we're doing different things. When we started the business 10 years ago, we quoted this phrase from Robert Frost about 2 roads diverged into the wood, and I took the road less traveled. And that has made all the difference. And we think going forward for the next 10 years, it's going to be exactly the same and even more pronounced and faster. So what do we have to do? We've got to get out of this little bowl. I've had to do so myself during COVID, and that's what I've learned. And I'm learning from the youngsters, like Greg and other people in our team. And I'm open. I've said the world is much bigger than I thought. And there are many other opportunities that we just didn't think about. We didn't go and look for them. and they're there, and we can just jump out into a new investment strategy. So with that, I want to thank you for listening to me, and I think it's all good news. We've done really well with the unit trust. We have fought back since March, April last year. We've changed the way we think. We've changed the way we manage the assets. And we think there's a very, very strong compelling case for these mega trends going forward. And we're going to expose our clients to these trends, speak to our financial advisors about it. This is really one of the first webinars that we're really exposing these ideas beyond just the research we've distributed. And we're going to have many more of these webinars, and we can empower you to consider all your options. So Nandi, with that, thank you very, very much.
Thank you, Duncan. Well, everyone, we trust that you found your time with us informative and valuable. As you step out today, you'll be greeted by a survey. As you log out of the webinar, you'll be greeted by a survey. Please feel free to add some words of your experience today. And we will also be sending you a recording with all of the information that we spent time on today. Again, if you have any further questions or even interest to get further information, we're more than welcome to provide that to you. Till next time.